So welcome back. So now this is a continuation of the other topic of capital budgeting. Now we looked at other methods of capital budgeting. Now we are looking at the project evaluation techniques. And number one, we looked at the discounting and the non-discounting techniques. Under discounting, under non-discounting, we had already checked on the profitability index, internal rate of return. Then under discounting, we see that we have various methods. One was the net present value, discounted payback period, the modified internal rate of return. Also, we have the profitability index as well as the internal rate of return. So we discussed the modified internal rate of return. We also discussed about the discounted payback period. We also discussed about the net present value. So now you're only remaining with two methods, and that's number 4. Method number 4 is the profitability index, PI. Now, what's profitability index? Now, profitability index, this is a relative measure of performance determined as follows. Now, this will determine the profitability index. Profitability index is the present value of cash inflow divided by the present value of cash outflow. So it shows the ratio of the return to the amount of capital you had invested. Now, when we apply profitability index, now profitability index is applied when the company is facing what we call the capital rationing to undertake all viable projects. I repeat again, that when you determine, when do you use a profitability index? Now, profitability index is applied when the company is facing capital rationing to undertake all investment projects. And what do we mean by capital rationing? Capital rationing. Now, capital rationing is the scarcity of the investment fund to undertake all viable projects. They're saying that is the scarcity of investment fund to undertake all viable projects which are independent. This is what I mean. You have project A, B, and C. Let's assume this one requires 40 million, requires 30 million, and 10 million. So that means in total, you require 8 million. Now, assume project A, B, and C, they are viable. Viable means the NPV is positive, and then assume that these projects are independent. If the projects are independent, you cannot use NPV to determine which one to accept, which one to reject. So if all projects are viable and they're independent, in case you have insufficient resources, you cannot take all the project. But now, if all these projects requires 8 million, but the company only has 60 million, so you see there is a deficit of 20 million. Now in that case, you cannot be able to determine, now how will you allocate these 60 million? So you cannot use net NPV since the projects are viable. And then we are saying another thing, that the projects are independent. Now when we face this, now that's when the company uses the method of profitability index. Good. So we are saying that capital rationing is the scarcity of investment fund to undertake all viable projects. And in that case, we cannot be able to use the net present value. And we have two types of capital rationing. Types of capital rationing. Now you don't have to write. Yeah, we already have the notes, so it's well summarized in the notes. And number one, we have what we call the soft or internally generated capital rationing. And number two, we have hard or externally generated capital rationing. So those are the two classifications of the capital rationing. They say that capital rationing is the scarcity of investment fund to undertake all viable projects. Now, starting with the first one, the soft or internally capital rationing. Now, this is the scarcity of investment fund due to the factors within the control of the management, or the scarcity of investment fund due to actions of the management. While hard or externally generated capital rationing is the scarcity of investment fund due to factors not within the control of the management. That's what we call the external factor. So that's the difference between the two. That under soft or internally generated capital rationing is the scarcity of investment fund due to factors within the control of the management. And what gives rise to internally capital rationing? Now, just reason, everything is in your notes. Number one, it's when the company or the management refuses to issue new shares so that to avoid dilution. You see this, what happens? For you to get this deficit of 20 million, assuming the company can issue new shares, it's a public company, it can issue new shares to get more capital. But in this case, the company fears that if you issue more shares, that means we'll have new shareholders. Whenever you have new shareholders, that means there'll be dilution of management and ownership. So they try to avoid that. So number one is when the management refuses to issue new share so as to avoid dilution. As you can see, that's something within the control of the management. Number two is when the management refuses to borrow more funds so as to avoid the commitment of payment of interest. So now this is what I mean. To get this 20 million, the company is creditworthy. That means they can approach the bank or they can issue debenture to get 20 million. That means they borrow an additional 20 million. But in this case, they are feeling that if we now increase our debt, that means we'll have to pay the interest. And the interest increases what you call the financial risk. So in that case, the management avoids that. So that's something within the control of the management, and that's one of the soft or internally generated capital rationing. Another factor that might give rise to soft or internally capital rationing is when the management set a limit of the capital budget. Have what we call the capital budget. Now, assuming at the beginning of the year, you had set a budget of the capital project that you have to take the project, the maximum we can spend is 60 million. But you see now, after the evaluation, the viable project requires 80 million. So that means you need 20 million. Now you approach the board of directors and you tell them that now you are facing a deficit of 20 million, so can you approve it? That means the company already has the money. But in this case, the board of director asks you as a financial manager, now how much had you budgeted for? You see that now, according to our budget, we had budgeted 60 million, and then they tell you, go and stick to your budget. You see, in this case, does not mean that the company does not have the additional 20 million. They have the 20 million, but in this case, the policy is that let's just stick to our budget. So that's something within the control of the management. Good. Then we have hard or externally generated capital rationing. We have said that this is the scarcity of investment fund due to factors not within the control of the management. Now, what are those factors? Number one, lack of security in case of borrowing. Now, in this case, the company is willing to get the 20 million through the borrowing. But in this case, they don't have any asset they can offer as a collateral. Then another circumstance that gives rise to externally generated capital rationing is when the capital market is depressed. Now, when the capital market is depressed, that means it's very hard or it becomes difficult for you to access the capital, because even the capital market provider or the capital provider, in that case, they are facing that which we call financial distress. Number three is whenever there is a high demand of investment funds